All right, guys, let's go ahead. Let's bring on Tom Hayes. How we doing?
How you doing, Mitch?
Go.
I saw your comments on Asana and some of the software stocks earlier in the segment. I agree with you. Yeah, I think you got to wait. I know a lot of people want that Asana because they see Dustin Moskowitz in there buying, 20 million a here, 20 million there. But I took a look at it over the weekend. The thing's still trading at 20 times sales, losing money, and it's just not the environment for that just yet.
Yeah, definitely. I said you got to look at that bottom line. If there's no profitability, don't go searching just yet. Wait till at least you see some trend kind of change there.
Yeah, that.
All right, let's go ahead. Let's dive into it. Let's get into first. Let's talk a little bit about market sentiment. We've been battling here. There's talks of correction, scared thoughts of how many Fed rate hikes we're looking at. What do you see right now in the market sentiment? Are you one of those people that are as far as 7 rate hikes, or are we looking closer more to like 2 or 3? What do you think?
Yeah, I'm going to take the under. I mean, the market's priced in 4 or 5. I'm going to take the under on that, maybe 3. The name of the game here, there was a lot of fear in the market two Mondays ago. It was complete capitulation, complete washout. And the thing you have to keep in mind, and you learn this through experience, I've been in the markets for 20 some odd years now. You're generally not going to get 20% bear market corrections in the S&P 500 without a recession. And recessions are always preceded by a yield curve inversion. The 2-year yield exceeds the 10-year yield. Now, the yield curve has been flattening since June, so we're keeping a strong eye on that, no question about it, but it's nowhere near inversion. And then finally, for a recession, you need 2 quarters of negative GDP growth, and we're expected to grow GDP by 4% this year. So, if you look at last Monday, there were a couple signs, and I was on Fox Business Network, talking about it in real time. One, the put call ratio hit 1.26%. So your viewers are probably familiar with the put call ratio. VIX was at 38, and the AAII sentiment of retail investors was down to 21. And if you look at that historically, that's usually at or near inflection points when the market starts to recover. And now that's exactly what it's doing. You had a quick, abrupt recovery, brought a lot of people in. Now it's digesting, consolidating, shaking out some of the late money. And I think we're going to push higher into that Fed meeting, barring, like you said, some ridiculous thing in Russia or Ukraine where no one is incentivized for that to happen. Macron is flying over there to beg for some gasoline, to beg for some natural gas, and to say, please don't bomb them, because you can't run an economy on windmills and solar panels alone. We're making the transition, but you're still going to need the fossil fuels for the foreseeable future, and I think they're figuring that out the hard way.
Yeah, definitely. Now, one thing that I've been watching is the market breadth, right? And how many stocks are really kind of leading the rally back up, and how many stocks really kind of held us up between this kind of drop. Now, one number that I've been watching is the SMA 200, what stocks are above and below. This number has gone as high as towards 20%. We were at 80% stocks below. Now we're at 28.1. Do you feel like the market breadth is getting a little bit better when we do get these drives back up in the SPY?
Yeah, I like I like to buy the market when the breadth is terrible, to be honest with you. I mean, that's when people are getting flushed out. That's when you're getting forced liquidations. That's when you're getting funds blowing up. We by nature are a contrarian group. I know you guys are talking about energy. We were very public in fall of 2020. This is over a year and a half now, pounding the table on energy when Exxon was at $36, $37, $38, pounding the table on banks when Wells Fargo was trading at a 55% discount to tangible book value. That's only happened 2 other times in the history of the company. Once during the great financial crisis in 08-09, once during the S&L crisis in the early 90s. And now that all of these companies, all these oil companies and all these banks have doubled and tripled, we're actually lightening up on the group while everyone else is getting very, very excited. So we take a kind of a longer term view than probably many of your viewers, but it's been worked very well for us over the years, because when you know what you own and you do some of the work behind it, you can really lean in its size. And that's how you build wealth over time. It's always fun to take trades and everything, but you got to manage your risk. You got to size it small. But when you really understand an investment, then time is your hedge and you can lean in aggressively. And there are a couple setting up right now. of the likes that I haven't seen since 2020 with the banks, with energy that we're now lightening up from.
Yeah, definitely. It actually leads into oil. Oil is my next topic here. It's one thing that I've been watching. I've been waiting for the turnaround, but trying to be patient for it. Right.
Yeah.
One thing that you can't do is you be early to the gun, especially when you're looking for a longer timed investment, like you're speaking about here. One of the things is not to be the first one to it, but definitely keep your eyes on it. That's why I've been looking at oil. We did see kind of comments come out, and I'm wondering how Russia will continue to affect oil. Could we get maybe oil to $120 a barrel?
I mean, look, anything is possible, Mitch. I'll tell you what I'd be more focused on, which is a higher probability. The probability of a Russia-Ukraine hot war is certainly present, but it's lower probability than what's going to take place in Vienna starting tomorrow, which is the Iran talks are going to restart about getting a nuclear deal signed. And there's a lot of pressure for this administration to get something done with Iran because of inflation. It's very hard to get reelected or for your party to carry seats in November in the midterm elections if you have 7% inflation. So what they want to do, they're incentivized in every way to get something done with Iran. You saw over the weekend removing some sanctions because Iran could quickly put 1.4 to 1.8 million barrels a day back on the market. And that could happen very, very quickly. And you could see $10, $15, $20 come off of oil very quickly. So you got two sides of the coin. Certainly, if you get an escalation to a hot war in Russia-Ukraine, which is lower probability, you maybe do see the triple digits that you're talking about. But on the other hand, you get some type of Iran deal, and then you get Macron over there de-escalating things in Russia-Ukraine. You could take $20 off really, really quick. Now, longer term, although we've been lightening up on the stuff we bought in 2020 in the energy patch that are now up double and triple, if we did get a hard correction in the group, we would be looking to add back, but at much lower levels. And I think if you're thinking about new money into the energy sector at these levels, the only place that looks attractive from our view, you could pick up nickels in front of steamrollers for some of the E&Ps that are already up 200% plus. But some of the servicers have really lagged, and now that the rig count's ticking up, that might be an area of some interest, for people who really want to get energy exposure.
Excellent. There you guys have it. Check that out. Let's go. Let's change wheels here. Let's get into a little bit what I've been looking at since last week. One of the things is I was seeing as January was going to be the worst for COVID, and it kind of was. We saw those numbers really skyrocket in infection rates. Do you feel that we're starting to finally get into kind of a reopening trade? Lodging kind of moving on up, cruises making a nice move, and it just feels like finally we're really getting towards that kind of later innings in COVID. What do you feel here?
Yeah, I think you're spot on with the reopening trade. I mean, there's so many different ways to express the reopening trade, and a lot of them have played out. You've seen, like for instance, Simon Property just reported, and I think they're down after hours. That was a huge reopening trade, but that started again, fall 2020, 2021, so it's a little late. Now, on some of the cruise ships, I like because they rallied off those 2020 lows. They rolled back over, and I heard you talking about, Royal Caribbean. That's kind of the highest quality, best in class play. I think certainly there's some legs there for the next 12 to 18 months, and probably your biggest upside with greatest volatility and risk is Carnival. But Carnival's not going anywhere, and I think that's interesting. If you have patience, you'll double your money, maybe triple your money over the next 12 to 18 months in a few names like that. And your best play where they've really, in some of these cases, taken on debt on their balance sheets, et cetera, you have to be careful. You want to buy a basket. If you're going to buy some airlines like you saw today, Frontier bought Spirit, ULCC, Frontier. That kind of looks a little bit interesting here. But buy a basket, American Airlines, United Airlines, 3 or 4, and just sit on it for the next 12 to 18 months. And that's how you double, triple your money over time. You just go for the low-hanging fruit. That's a no-brainer. Ignore the short-term volatility. You're in good companies. The long-term track record, you're going to be okay over time.
Love it. Love it. We are definitely definitely all about baskets here on Money Mitch, so I appreciate you mentioning that. It's definitely a great way to go about it, especially when one thing that we try to do is kind of move with the story and move with kind of the news flow. You kind of want to get into a couple of names, so hopefully maybe you get a positive catalyst out of one. You know, you can get an analyst rating upgrade, something like that. You can catch
Oh,
something.
I got one that I think is very interesting that's
Perfect.
right in line with your reopening. And I think a better way to play the reopening at these levels and at this stage in the recovery. I like Boeing. It's boring. It's done nothing for the last year plus. And there is a catalyst on the time horizon. And they've been, putting hints. Management keeps saying it's coming, it's coming, it's coming. It's supposed to come by the end of the year. We got a plan for them to get recertified in China. We didn't get the recertification. Now they're following the plan. They said they'd be done by the end of January. It's not done, but it's imminent. And when that happens, I think you've got, I think it's moved up from 185 to like 210 maybe today, somewhere in there. Mm-hmm. Where did it close today? 210 or so?
Yeah, right above, right. Closes 207.56, got to a high of 214.
Yeah. So, I mean, look, this is a stock. This is still down 50 some odd percent from its pre-pandemic highs. They operate in a duopoly. If you want to fly people around, you're either calling Airbus or you're calling Boeing. And that's a good position to be in because it gives you pricing power. And as we come out of this, as well as I and your viewers know, watching, the first thing you want to do, you're seeing it already. Money spending is shifting from demand for goods to demand for services, which is going to help alleviate some of the inflation pressure and the supply chain pressures as well. But you want to be in Boeing, and this is one you want to take a 24-month view. It probably works out much sooner, but you have a $200 stock that's definitely going to push above 300 and over time make new highs. If it's 2 years, if it's 3 years, the demand is there. And the minute they get that China recertification, that's when you get your first pop. Probably third, when they have the green light to fly in China, maybe you get 40, 50, 60 points in the short term. And then the long term, this thing is just a great play as the demand comes back stronger than ever because people have been cooped up for 2 years. The only thing they want to do is get on a plane and possibly get on a cruise.
Perfect. I think you couldn't have said it better there. Definitely appreciate you bringing Boeing there. Last thing I want to ask is Disney earnings coming after the close Wednesday. Yeah. Of course, we've seen kind of the subscription numbers start slowing down. Netflix got that big hurting off after their earnings.
Yeah.
What do you see Disney kind of lining up here?
Yeah, net ads is the name of the game. You hit the nail on the head. Netflix was taken to the woodshed. Street's looking for 7 million ads. They only got 2 million ads last quarter on Disney Plus. But Evercore ISI was out with a note talking about the Disney Plus downloads have really accelerated in the last quarter. So that's positive. I think the upside surprise, expectations are low with Omicron with the parks. I think the parks are going to be stronger than people anticipate. I think that's going to be a positive tailwind. If you look at the ads on ESPN Plus, were pretty strong last quarter. That may be another positive surprise. Hulu's kind of just floating along there, but we really do want to see those net ads close to 7 million, or it could be punished. But I think again, if you step back, and I know the story during pandemic has been about Disney Plus, and that's kind of like how they held up the stock. But the story moving forward, again, talk about a business with a moat. The parks, people want to get on planes, but where are they going? They're going to Disneyland. Okay. And everyone wants to get to Disneyland. And I think their park admissions are going to go through the roof. And this is a stock to own for the next 12 to 24 months. So if you're not in it and you want to be in it, I would never put on a huge position right before earnings. Maybe put at 10 or 20% of what you want to put. If they miss on earnings, you can add a lot more. And if they beat, wait a couple days for it to calm down, and then you can start to layer in and think about it over 12, 24 months. I mean, this is a stock you can hand down to your kids and grandkids. I mean, this is a no-brainer over time.
All right, perfect. Thank you for joining us, Tom Hayes. This is the chairman of Great Hill Capital, guys. I also am going to throw up a link here if you guys want to check out the free stock market newsletter that they offer. So definitely check that on out. And where else can they find you, Tom?
Yeah, just go to hedgefundtips.com. We've got a weekly podcast and video cast you can find on there. It's very popular. It's rated number 2 in the hedge fund category by FeedSpot. And then you'll find all of us. We manage money for accredited investors and large institutions. So that may not apply to a lot of people, but we have a lot of free stuff, a lot of great content that you'll find very helpful, regardless of what level you're at or what size accounts you have.
Hey, well, thank you for joining us. We'll definitely bring you back, and I appreciate the comments, especially about Bowen. A little bonus for the audience.
Thanks, Mitch. Thanks for having me on.
All right, guys.